Welcome back to Echo Trade. Your host, Jeff Roth, here. And we are today talking with Thurman Kelley from Brookmont Capital Management. And Thurman's given us the download on tax efficient investing, kind of an overview of tax efficient investing, as well as how their portfolio, which one of them is available within Echo Trade, is tax efficient in and of itself. So let's jump right in. Hey, Thurman, how's it going, man?
Good. How you doing, Jeff?
I'm good. I'm good. You're looking sharp and studious with the glasses today. I didn't wear mine. Trying to look
Yeah,
cooler.
I'm sick of the contacts right now, so I got to go to the glasses.
I feel you. I feel you. I actually just started wearing glasses like this summer. I'm 42, and I made the leap. My wife forced me into it, but can't wear them all the time. But let's talk about tax efficient investing. So basically, give us kind of an overview, just kind of the 101. What is tax efficient investing? How is it different than like just basically regular investing without kind of thinking about tax implications at all?
Yeah, so there's all kinds of different ways you can be efficient tax wise with the way you're investing. And what tax efficient investing really means is just trying to keep your tax bill as low as possible at the forefront of your mind whenever you are investing. So there's a couple things that we do with our portfolio. One thing is just we buy and hold these names for, we say 3 to 5 years. Typically, it's 3 years to forever. Some names in our portfolio have been there since the very beginning because they're just good quality names that we don't want to sell out of. And also, if we realize those gains, since we've had Home Depot in the portfolio since 2008. If we realize that gain in some of our private client accounts, then that would be a huge tax bill from that. So we're always keeping that in the forefront of our mind. Obviously, if one of the companies we're invested in, their fundamentals are breaking down drastically, we're going to have to just, sell it and take the gain. But typically, the companies we own, we don't ever plan on selling out of them because they're able to continuously compound cash flow and grow with the American economy as well. And they're typically industry leaders. So that's one way to think about it, is just buy and hold really good companies forever. Another way is to basically, when you do enter a new position, don't sell out of it within a year. Wait till that 12-month period so you get a long-term capital gain tax rate on that, which is much more beneficial than ordinary income. And another way we do it is, since we are a dividend manager, there is the difference between qualified dividends and non-qualified dividends. So if we buy a name with a dividend in the portfolio, if you hold that name for 60 days, then the income from that dividend actually it is taxed at a long-term capital gain rate instead of ordinary income. And you may ask, like, well, 60 days isn't a long time to get, long-term capital gain rate on a dividend. Yeah, that's true. But a lot of managers in our space, in the dividend space, are writing options on top of these names that they hold in their portfolio to help get a little extra yield and cash flow for their clients. And one of the downsides of doing that is, if you're writing options on these names that you own, the income you're receiving from that dividend and the call option, or whatever other options you're trading around it, actually makes it unqualified, so it starts being taxed at ordinary income. So our strategy is simple: just buy and hold, and also we don't trade options around these names to make it as tax efficient as possible for our clients. And we also keep our turnover rate very low. So we're usually between 5 and 15% in terms of portfolio turnover per year. Obviously, we want to be active and pick great companies, but we don't want to be too active and bounce around from name to name and cause a huge tax bill for our clients. So the way our portfolio is constructed is to be very tax efficient, just from the get-go of it, in terms of the construction, the activity, and also the types of securities that we hold in it.
Perfect. Can you clarify a little bit then? You talked about, kind of holding the dividends with at least 60 days, and then also holding just an individual name, the security, at least a year. So clarify kind of the differences between those, like in terms of, a year plus or less than a year.
Yeah. So in terms of like the qualified versus non-qualified dividend, when I'm talking about the tax rate on that, it's the actual yield that's coming off that security. So let's
Yeah.
say Home Depot's yielding 4% right now. I don't know what their exact dividend rate is right now, but if they're yielding 4%, that 4% yield that you get that year, within the first 60 days, that's taxed as ordinary income. But if you're not trading around it, then it's taxed as long-term capital gains, which is significantly lower depending on whatever your tax bracket is. It could be 0, 10, or 20% for your client. And then in terms of short-term versus capital gains, if you hold a security for longer than 12 months, that becomes a long-term capital gain. And with that, you're taxed at a much lower rate than you would on short term. So a lot of these tactical managers out there that are bouncing in and out of asset classes, they have a much higher tax bill because they're not necessarily holding any of these securities for a long term. They're jumping in and out of treasury bills, going back into equities, maybe buying some ETFs, and then bouncing out of that real quickly. So there's a lot of different ways to invest, and the way we do it is what we think is probably the most tax efficient way possible, while still being an active manager and not just buying the S&P 500 index with that. And then
Exactly.
yeah, and another thing that we do, or we have the capability of doing that we do for a lot of our clients, is since our account structure is a separate account, which means the end client sees all the securities they own. It doesn't show up as a ticker like an ETF. Ours is every individual holding in the name. So like Pepsi, Unilever, Home Depot, JP Morgan, they see all the individual holdings. So with that, at the end of the year, what they can do is actually lower their tax bill by tax loss harvesting. And you do that by selling out of the names that have a loss, currently have a loss on the books. You sell out of those to offset some of the gains that you already have. So with that, you try to get your tax bill as close to zero as possible without necessarily your account going down, because you're able to harvest the losers of the portfolio against the winners. So that's
So
a
talk
very
about
efficient.
that. Oh, sorry. Talk about that a little bit actually in relation to kind of the different account types that you can actually be investing in as an individual investor, whether it's a self-directed brokerage account or you can invest in a mutual fund in relation to tax loss harvesting and kind of writing off the losses.
Yeah, so we're a separate account, is what they call us in the business, but it's just an individual brokerage account that we
Yeah.
manage for you.
Yes.
So when you do that, you have the ability to tax loss harvest the individual names. But if you buy someone who does dividend investing, but they do it through an ETF, excuse me, the individual holdings in that ETF, you can't tax loss harvest those. The ETF manager won't do that because it's just one security that you're showing on your statement. So you can't tax loss harvest those ETFs unless you're buying a bunch of them and doing it, running it almost a separate account of ETFs. But if you want the individual holdings, then you can't tax loss harvest those. And then a mutual fund is a whole different thing, because mutual funds have capital gains distributions as well. So last year, a lot of people that were in mutual funds, they might have been down for the year, but that mutual fund had a capital gain distribution. So they actually paid capital gains taxes on like a down performance year for a lot of these companies, because a lot of these mutual funds had to sell out of certain names that they held for a while, and that caused a capital gains distribution trigger. So that's another advantageous part of the product we run, is basically an individual brokerage of the individual securities. It's a lot more tax advantageous than a mutual fund.
And likewise, if you're not a client of Brookmont, but you're getting access through EchoTrade and you're using an IRA, Roth IRA, or a self-directed brokerage account, you're getting the similar benefits exactly versus a mutual fund or an ETF.
Yeah, exactly. So that's another benefit of using EchoTrade, is you can get active management from people like us, while still having the most tax efficient structure. Because your other option is to go buy a mutual fund that does dividend growth, but you might get hit with a capital gains distribution that you didn't participate in. So that's another benefit of using this platform for the individual investor.
Exactly. So perfect. I mean, I appreciate it. This has been insightful in terms of kind of the different types of products you can use. Appreciate it, Thurman. And investors can take a look at the Brookmont dividend growth strategy on EchoTrade. And again, it is going to be a more tax efficient method to invest versus, putting your money into a mutual fund or an ETF individually. So Thurman, appreciate your time. Thanks a lot for being here.
Thanks, Jeff. Appreciate it.